If your money is sitting there and it feels like nothing is actually happening, this video is for you. I'm going to walk you through 7 of the most common investing mistakes I see people make, including ones that I've made myself. Now you might be thinking, I'm already investing, I'm doing the right thing, I'm ahead of most people, and maybe that is true. But here's the thing, doing something isn't the same as doing it right. And a lot of people are investing consistently and still falling behind. Not because they're lazy or uninformed, but because a few small missteps are compounding against them just as fast as their money is compounding for them. By the end of this video, you will know exactly what those missteps are and most importantly, how to fix them. So mistake number 1 is waiting for the right time to invest. The market is too high, the economy feels uncertain, you'll start next month. Does this sound familiar? Timing the market is one of the oldest traps in investing, and the data is brutally clear on this. Missing just the 10 best days in the market over a 20-year period can cut your returns nearly in half. The right time to invest is almost always right now. Consistent, boring, regular investing almost always beats waiting every single time. Mistake number 2, not understanding what you're buying. This one is more common than people admit. A lot of investors, especially beginners, buy a stock or a fund because someone online was excited about it, and they did not have an understanding of what the company did, what the expense ratio is, or how it fit their overall strategy. If you can't explain it in one sentence why you own something, then that is a problem. Now look, you don't need to be an analyst, you just need a basic understanding of what you're holding and why. Mistake number 3 is letting your emotions drive your decisions. Look, markets drop and it feels terrible. You sell and then the market recovers and you've missed all those gains. This cycle has cost everyday investors more money than almost anything else. The instinct to protect yourself when things look scary is completely natural. But in investing, it is almost always the wrong move to pull your money out when markets are going down. The investors who win long-term are the ones who build a plan and follow it, regardless of what some scary headline says. If you're finding any of these mistakes helpful, give the video a like and subscribe to my channel. It really encourages me to keep making content for you guys. Mistake number 4 is ignoring fees. Fees are the silent killer of long-term wealth. A 1% difference in expense ratios might sound insignificant, but over 30 years it can cost you tens of thousands of dollars, sometimes even hundreds of thousands of dollars in lost compounding. Before you invest in anything, look at the expense ratio. Index funds and ETFs from providers like Vanguard, Fidelity, or Schwab often charge a fraction of what actively managed funds do, and they frequently outperform them as well. Low expense ratios are often below 0.05%. Mistake number 5, not diversifying. Putting everything into one stock, one sector, or even one asset class is a bet. That's not an investment strategy. Diversification isn't about being timid, it's about making sure one bad decision or one bad year doesn't permanently set you back. A simple 3-fund portfolio of US stocks, international stocks, and bonds gives most people more than enough coverage to build real wealth over time. Mistake number 6 is skipping your employer match. If your employer offers a 401k match and you're not contributing enough to get the full amount, you are leaving free money on the table. That match could be an instant 50 to 100% return on your contributions before the market does anything. It is genuinely the best return available to most working Americans. Prioritize this before almost anything else you invest in. Mistake number 7 is stopping when the market gets scary. This is the one that separates long-term wealth builders from everyone else. When markets drop, most people pause their contributions or pull back. But a market downturn means you're buying shares at a discount. And who doesn't like a good discount? The investors who kept contributing through the 2008 crash and the 2020 crash, they came out significantly ahead. Staying consistent during these volatile times is one of the best things you can do. When the market is down, you are buying at a discount, and when it recovers, you come out ahead. Those are 7 of the most common mistakes I see. Some of them you might already be avoiding, and if so, good job. But if one of these hits home for you, that's the one you should start focusing on. Investing doesn't have to be complicated. It mostly just has to be consistent and intentional. fix the mistakes, let time do the work, and the results will follow. Thank you so much for watching, and I will see you in the next one.